Hi everyone. Welcome to another episode of Zero the Decade. Today we'll be talking about floating rate funds. Interest rates in India are at multi-decade lows, and this is happening due to the severe macroeconomic shocks due to COVID. We seem to be recovering slowly, but the consensus view seems to be that the rate cut cycle is over and we may soon enter a rate hike cycle, which means this is not very good for debt investors. Now, given the reality, there has been an increasing discussion around floating rate funds. These funds are very different from other bond funds and tend to do well in a rising rate environment. This is a very small category and isn't very popular among investors. There also seems to be some misconceptions and confusion in terms of how these funds work and how they should be used in a portfolio. So IDFC Mutual Fund is coming up with an NFO for their floating rate fund, and we decided to catch up with Arvind Subramanian from IDFC Mutual Fund to talk in depth about what their floating rate funds are and how they work. So you'll get some perspective on how you can use these funds in your portfolio. Arvind has an experience of over a decade in the mutual fund industry. Prior to IDFC AMC, he worked as a senior analyst at ICRA Limited. Now, before we deep dive into the entire discussion, Arvind, could you let us know about how you got started in the world of finance and why did you choose fixed income, which tends to be boring, versus glamorous equities, and how did you end up at IDFC Mutual Fund?
Sure. I think my story is nothing too different from most people in an MBA college who's, at that point in time still trying to figure out what they want to do with their life. I remember this was 2009 when I graduated, which was equally one of the most toughest periods from an employment side, because that was when Lehman crisis, everything happened just when I was graduating and looking for a job. So in a way, it was not really what you would want to do during that time. It is almost what you get, which is the reality of at least that situation. Very grateful and thankful that at that point in time, I got an opportunity to work with ICRA Limited in financial services credit analysis. That was an industry which was doing very well at that point in time. And at least personally, one of the few things I've been good at over at least my schooling and college, etc., was the analytical side of things. I think that helped. So it was not something that I always aimed to do or aimed to get into. It, I think, just happened. Post ICRA, and ICRA, I think, is a fantastic place to start a career in credit analysis. Just the way they are structured, the kind of exposure you get, the kind of companies you're able to look at, small companies, medium companies, companies which are not even tracked in the broader market. You looking at those companies actually teaches you a lot, because governance, audit standards, etc., are not the best when you go really micro. They don't have as flashy an annual report as you see with some of the large companies. So understanding and ability to assess and gauge those companies really helps. So 2 years, excellent time at ICRA. I think it's a very good place to learn credit. And then the opening at IDFC Mutual came through. I joined as a credit analyst in 2011 in the fixed income team. And since then, that has been a very simple career for me of just two companies. So almost 10 years now with IDFC Mutual, where over a period of time, the company has grown well. The AMC has done well in terms of AUM. The fixed income piece has done very well. And yeah, that's the transition and the journey for me over this period of time.
Arvind, before we talk about floating rate funds, wanted to get your views on what do you think about the current interest rate environment? Do you think that since these are the rates are at historic lows, is it only up from here, or do you see it differently?
I think there's a bit of nuance to look at it. Maybe I think two useful aspects to delve into when I maybe talk about where we are in the interest rate cycle. For example, you just take the last two events of the previous week, which was the Indian budget and RBI policy. If you look at the budget, what we think is it was a very good cleanup exercise from the government in terms of portraying a very true and fair picture of the fiscal deficit. But in doing so, what possibly spooked the bond market was the higher borrowing number, almost an extra 80,000 in this quarter and almost another 1 lakh crore next year, which had an impact on the bond market. Having said that, going into the budget as well, most market participants were of the view that or were expecting or were still are of the view that RBI would still have to do a lot of heavy lifting to ensure the borrowing program goes smoothly and the bond market is not too disrupted because of all of this. Because keep in mind, we're coming out of a very exceptional year of what has happened with COVID and the destruction in various parts of the economy. So going in, we were anyway expecting a certain amount of support from RBI. I don't think that changes, or that thesis changes, wherein we expect or we will continue to expect RBI to continue to ensure an orderly going through of the borrowing program. Post that, we had the RBI policy, wherein the governor actually was quite clear in reiterating the fact that, he will ensure liquidity is abundant. He kept rates on hold, but the accommodative stance was maintained. He did highlight that they would ensure the fiscal borrowing does not or goes through in a very non-disruptive way. Therefore, all told, you are at a balance today. Net, we do believe as a fund house that we expect a gentle bear flattening of the yield curve. By that I mean the front end of the curve could start seeing a bulk of the flattening of the curve, wherein the yields start to inch up, and the long end may not have that much of a moving up to do, such that you tend to flatten the curve. Keep in mind, today the yield curve is extremely steep. Between the overnight to the 5-year to the 8-year to the 10-year, there is real steepness. Therefore, we still find pockets of opportunity in the, say, 5 to 8-year segment, given the very, very high steepness and the view that RBI would, in a way, ensure a very gentle normalization of the exceptional policies that they have put in place over the last 1 year.
Arvind, what do you mean by the steepness of the curve across various maturities?
Sure. So very simply, the overnight rate today, for example, I don't know the exact numbers, say would be around 3.5, or I would say 1 month to 3 months rate for, say, a T-bill or the overnight would be around 3 and 3.5. A 5-year government bond today would be in the vicinity of 5.5 to 560 to 570 even. A 7-8-year government bond would be in excess of 6%. So for example, the 8-year to the overnight, there is almost a 250 to 300 basis steepness in the curve. We believe there will be a gentle flattening of that, wherein the front end rates would tend to gradually shift up. And keep in mind, the very important word is gradual. It will not be very violent in our view. A gradual shift up in the front end of the curve would result in the curve starting to flatten a little more during the course of the year, which is our base case view.
Arvind, could you also, because this seems interesting, could you also elaborate on what it means if the curve is steeper, or what it means if the curve is flatter?
It is more just a function of how so the yield curve gives you a good signal of both demand and supply across various pockets. And it can also tell you various things, which is obviously a very nuanced science, but very simply, if there is a lot of excess liquidity, wherein people are chasing only the 1 to 3-year segment or the 1 to 5-year segment of assets, you would see a steep yield curve because the front end rates would be much lower given the excess demand for these papers versus the supply, or vice versa. If the borrowing at the long end is very high versus the demand for that segment, you will see a steep curve because all of a sudden, the demand supply mismatch is much more pronounced there. It's more just a function of how the demand supply scenario in various parts of the yield curve are. If you look at it, because of the exceptional liquidity situation over the last 1 year or so, you are potentially seeing a situation where there's been a huge amount of demand for front-end assets, and therefore you could potentially have seen a steep yield curve. Having said that, there are various other reasons as well for the steep yield curve, not just this one alone.
Things are also looking like very weird globally. Now, given that most of the developed world is near zero interest rates or maybe even negative, how do you think this affects India and like the investors in India who want to make debt a part of their portfolio?
I think that is a little too complex, or maybe making things a little too complex from an investment standpoint. Yes, there may be aspects for sure that play into the role of the Indian debt market. To try and ascribe certain aspects of global markets and try and make that into a view for you to then allocate into Indian fixed income, I think gets a little too complicated for an investor, and also may not necessarily add too much value. Given that one, if you look at it from a fixed income investor standpoint, your aim is to essentially provide stable returns with an ability to hopefully beat inflation without taking too much of exceptional or additional risk. I think if that core thesis is maintained and then therefore looking at inflation expectation, the rates, etc., I think that would be a easier way to look at it rather than trying to maybe complicate too much, because like you rightly said, there are various moving parts in the global market, and trying to pinpoint which aspect would impact Indian market, etc., might also be very may not really serve the purpose in that way.
Yeah. So let's dive in with the basics of how floating rate funds work. Could you like tell us about floating rate funds, what they are, how are they different from normal debt funds, and if possible, could you give us an example of how these funds work?
Sure, sure. Uh, uh, and I also hope that in this I will try and address some of the, like you had actually initially talked about, some of the misnomers about the fund structure. So I'll try and definitely address that. A floating rate fund is, at least by SEBI definition, a fund which should have at least 65% of the portfolio in floating rate instruments. Now, ideally, in a normal market where you have sufficient supply of now floating rate bonds, that would mean 65% of the fund is invested in securities wherein the coupon is not fixed, but it is linked to a certain benchmark, which is floating in nature, which means if interest rates go up, that coupon gets reset higher, so that you get some protection in the if interest rates go up. Now that is the ideal construct. I think it's very important, and this is an extremely important point for investors to understand that there are not enough or sufficient floating rate instruments in the market or floating rate securities in the market necessarily. Maybe because, I mean, we are still a little while away from having that developed. Therefore, what funds would do is you would construct a 100% fixed rate portfolio of how you would construct any other fund, wherein you buy fixed rate papers of various companies, and you synthetically convert that into a floating rate using the OIS market, wherein you pay a fixed and you receive a floating leg. You would do this, suppose you have no floating rate instrument in your fund, you would do this up to 65% of your overall portfolio. Now that's the general construct. So my sense is, in general, most categories in this, most funds in this category would have some bit of floating rate instruments in the portfolio, and the rest would be constructed synthetically through the OIS market by paying a fixed rate and receiving a floating rate. Just to further simplify it, all I'm doing by doing this is, while my bond underlying is fixed rate, by me going to another counterparty and paying him a fixed and receiving a floating, therefore means my fund is synthetically a floating rate. Now, very important to note, and if there is one important takeaway that I would love to have in all of this is in itself not 100% hedge or protection in a rising rate environment. Because keep in mind, even today, a floating rate fund, after the hedges that they do by paying a swap, still have a net maturity in the fund, which is I would have bought a 3-year bond and I would have taken a swap or a hedge position for maybe a month by paying a 1 month fixed. And so in the 1 month OIS market, therefore you still have a net maturity in the bond and also a net maturity in the fund. Now, as long as your net maturity is the main thing to watch out for, because if your net maturity is a certain number, could be 1 year, 2 year, 3 year, depending on various funds in the market, that would still be susceptible to a mark-to-market risk if interest rates were to go up. It only has a limited protection up to the extent of the hedge, but the net maturity, which is the gross maturity of the underlying fund minus the swap position, net maturity, if it is still 1, 2 or 3 years, like any other fund, would be susceptible to mark-to-market risk in a interest rate rising scenario. Just another point on this, and I hope not to complicate it too much, but in the OIS market, it is not necessary that the OIS market always moves in perfect synchronism with either the underlying rate environment or even the underlying bonds that you've bought. Because the OIS market has different demand and supply drivers, and your fixed rate market might be having a different set of participants. It is not necessary that both move in synchronism such that you get that perfect hedge. So these are two important aspects to keep in mind when people assess a floating rate. And therefore, I would again like to reiterate that one big takeaway in all of this, which is do not think a floating rate fund is your answer to a rising interest rate scenario. Please understand also for sure that if there's a net maturity in the fund, which could be 1, 2, 3, you will have susceptibility to mark-to-market volatility in the event of interest rates going up.
Arvind, could you explain like this swap transaction with an example?
Sure. To keep it simple, now suppose I construct a portfolio of 100 rupees. So I will do two legs. First, I will construct my portfolio like I normally do. 100 rupees of portfolio is constructed, and let's say hypothetically, the blended yield on that portfolio is 5%. Just to keep a simple number, that is 5%. Now separately, and suppose let's say that portfolio has no floating rate instrument because like I said, you may or may not have sufficient availability. You would have some, but let's just, for keeping it simple, have no floating rate instrument. So then what I will do is for 65% of the notional 100 rupees. So for 65 rupees worth of OIS transaction, 65 is the notional principal. It is not really exchanged with the counterparty. You will essentially go to a bank or a primary dealer. You will pay the OIS. You will essentially pay a fixed rate. It could be 4%, it could be 4.5%, and you will receive the floating rate leg, which could be 375 or 4%. There could be a difference. It will not always match because the floating leg is linked to an external benchmark, which is the MIBOR mostly. That is how you would, so therefore you have a 100 rupee leg, which is fixed at a 5% yield roughly. And then you do a separate transaction with a set of counterparties up to 65 rupees of notional principal, wherein you pay say 4% and receive 375. I'm just giving an example, but that 375 leg is variable.
Yeah.
And that's the simple explanation of how this.
So let's say if I have some instruments where the instrument is worth 100 rupees of capital, and I'm supposed to get a fixed interest rate of 5 rupees per annum, I can maybe go to somebody who's providing that swap facility and ask them how much is the floating rate right now. Let's say they tell me it's 5.5. By paying them a markup of 50 paisa, I'll tell them that I'll exchange my fixed rate with you. I'll give you my fixed interest for the year, and you give me your floating interest for the year. So tomorrow, if the interest rate becomes 6 paisa or 6%, then I'll be getting 6% return, whereas these people, they'll be getting 5% return. Is that understanding correct?
That's right. That's right. That's a simple and good way to essentially put this transaction.
Yeah. Now, I was doing some research on how these interest rate swaps work, And wanted to understand from you who creates these swaps and what would be the risks involved when it comes to like entering into such transactions? Is the capital also at risk? Or if you can explain these things in layman terms.
Okay, good. No, that's a good question. Who does this in the sense that by and large it'll be a counterparty of a bank, a foreign bank, or a primary dealer who takes the opposite view. So now suppose I want to pay fixed and he pays me floating. The counterparty there who's paying me floating and receiving my fixed is either a bank, a primary dealer, a foreign bank, etc. Uh, is the principal transacted? No. We keep a 100 rupee notional principal, and on that principle we calculate the difference, like you said, 5 and 5 quarter or 475 and 5 on 100 rupee notional principle. And we also said what tenure are we looking at, a 1 month swap, a 3 month, a 6 month, 1 year, etc. And accordingly then just settle the difference. You don't even need to essentially transact the full amount. You just settle the difference, and you settle the difference at various frequencies. It could be fortnightly, it could be monthly, it could be daily. uh, that is the operational leg of all of this. Uh, you were saying about other risks. Like I said, one risk is it may not always move in sync with your underlying portfolio, because like I said, this is a market where any participant can just come and take a view. He may not necessarily need that underlying. He can just come and take a view. It's like the unfunded market. You can take it's a very dynamic and view taking market, and therefore it may not always move in sync with your underlying portfolio. That's one risk. The other risk is maybe you have a counterparty risk to the extent of that very small amount of settlement. Like I said, 5 and 5 quarters, so the difference or the mark to market difference. If I'm in gain or I'm in loss, a counterparty credit risk could come into picture. Most of these cases, these are banks or primary dealers, but that is also one potential risk that you could potentially ascribe to this.
And the floating rate itself, it's based on which rate? For example, the floating rate bonds outside of India mostly on LIBOR as the underlying, and they can be some basis points above LIBOR or below, like whatever.
Yeah.
So here, what are they based on?
It's generally on the MIBOR, which is the Mumbai Interbank Rate, or even a T-bill rate. So you can even
Okay.
have a floating rate bond linked to 3 month T-bill.
Okay.
So as and when the 3 month T-bill moves up or down, this, and like you rightly said, it will be 3 month T-bill plus a certain spread, because the issuing entity himself may not be of the same credit worthiness of a T-bill, and therefore it will be T-bill plus a spread basis the uh, 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 entity which is issuing the floating rate bond.
And just to clarify for the listeners, the floating rate funds may not always be a perfect hedge for the rising rate environment. Could you elaborate more on that?
Absolutely, yes. And again, this is something I want to 100% reiterate in this. It'll be very useful and it's very good that we're getting this forum to share this, because suppose I take a 3-year fixed rate position across the fund. Now, in a sense, I'm saying, like I told you, going back to my example, let's assume there is no floating rate bond, and 100 rupees of my fund is in 2 and 3 year fixed rate bonds. It is not necessary that I would take a OIS or a swap position for a 3-year product. I would take maybe a 1 month swap or a 3 month fixed to floating leg. Therefore, the underlying portfolio, when rates go up, which is fixed in nature, will have its mark to market movement, and the swap leg might have a different movement. Now, therefore, like I said, on one hand, you have a 2-year fixed product, a 2-year fixed set of bonds, minus suppose you say I'm taking a hedge for a 2 month or a 3 month, my net maturity at the fund level would still be 1 year or 2 years. It will not be zero. Uh, because there is no free lunch wherein I can have a zero maturity and still a yield of 4.5 or 5%, right? To get a certain yield, I need to have some amount of curve risk as well. So given my net maturity after my swap positions is still 1 year or 2 years, if interest rates go up, like with any bond product or fixed income product, the maturity does have a role to play in the mark to market impact. And hence I definitely would want to reiterate that this does not provide a perfect hedge or is not a solution entirely to a rising interest rate scenario.
Arvind, what would be the costs involved in such swaps and such agreements that the mutual fund might enter into?
In a cost, I mean, there is no, is it operational cost? I don't think it is very meaningful. Uh, the cost is essentially at the fund level, you might lose a few basis points because if the fixed rate that I pay in the swap transaction is higher than the floating rate that I receive, it's a few basis differential, which is essentially you could look at as a cost. I wouldn't also term it as a cost in that sense, but that could be perceived as uh, a cost, or you're essentially therefore yielding at a portfolio level a few basis less because of the difference in fixed and floating. Otherwise, I really don't have a clear this thing on, is there any operational cost? Not really.
Okay. Arvind, you mentioned that 65% of the portfolio that the floating rate bond fund is maintaining can be hedged against, and the underlying would be fixed, and they can use swaps to enter into that floating rate arrangement. Now, the 35%, can that be floating rate bonds itself?
The floating rate bond would count in the 65%.
Okay, okay, okay.
So I was just giving an extreme example of suppose not having any floating rate bonds. But having said that, there are some amount of floating rate bonds in the market. So what you would end up mostly seeing is a certain percentage of floating rate bonds. The rest of it would be synthetically done up to 65% at least
Okay.
through the swaps. And then depending on a fund manager view, either you can have it at 100% floating or at just 65. And the rest could be just fixed rate. But that depends, of course, on the fund manager view at the time.
The fund that you're launching right now, what sort of breakup will it have?
In terms of the fixed and floating,
The fixed and floating, the entire 100% breakup?
that I think it's too early to comment on. Let's see as and when things develop. What we can only say at this point in time is from a regulatory requirement, it has to be at least 65%. I think the rest in terms of how much exactly we'll have to see it, and it'll vary depending on various points in time and the view that
Just to
we have.
clarify, it's at least 65% or at most 65%, the floating rate?
At the least 65. So it
Okay,
should be
okay.
65 to 100%.
Okay, so you could hedge the entire
You can
portfolio.
have.
Okay, got it. Now, in such funds, what would be the role of the fund manager? What would they be looking at? How would they uh, be employing the hedges?
Sure. So there are two roles by and large for that of a fund manager. One is like we see in any traditional fixed income fund, which is just the general underlying construction of the fund, which incorporates the interest rate view and the credit view and the liquidity view. So it's essentially three risks or three parameters that one needs to keep in mind when constructing a fund, any fund, and that applies to this fund as well. On the interest rate side, it would mean what overall maturity do you want for the portfolio? Within the overall maturity, what type of strategy you want to employ? What buckets do you want to have a overweight in the 1 year or the 6 month or a 2 year or a 3 year? So that is one aspect of the interest rate view that will come into the picture. Second aspect is on credit risk because we're still buying underlying companies papers in this case, whether it is fixed or floating, your credit risk is still there. So defining the credit universe that you want to participate in, analyzing those companies, monitoring the companies, and we have a team of credit analysts also who help with that. That would be the view for the credit angle. And then a liquidity angle to ensure that the portfolio is not too illiquid and to ensure that, inflow, outflows, etc. can be met and you have sufficient liquidity to meet. So it's a mix of these three, which is there in any other fund. And in addition, like you had rightly said, there's another leg of this, which is entering into your swap transactions with the counterparties basis your view. Do I want to do a 1 month swap, or underlying with a 1 month or a 3 month or a 6 month part of the curve? That's the other view. Again, basis the general interest rate view that you will have.
Arvind, one other thing that people say is that floating rate funds are like for rising rate environments, I mean, there would be some risk as you pointed out, but would they also be like a option for low interest rate or falling interest rate environments? Is it something that people could consider, or does it make sense?
Um, it does because, and again, it cannot just be plugged only for a low or a or a rising or a falling interest rate, because it again comes back to the net maturity of the fund. You could have, and I'm just giving an example, you could have a fixed rate or a normal fund in a category with, say, a 1 year maturity. You could have a floating rate fund with a net maturity of 2 years after all the hedges. One would think the floating rate fund, because of the name, would do better in a rising rate environment, and the first fund I talked about would do worse. But actually that's not the case, because the first fund I talked about has only a 1 year maturity at a portfolio level, whereas a floating rate fund, in spite of all his hedges, has a 2 year maturity. So he will still have more mark to market impact. And on the vice versa, if rates were to fall, one would think the fixed rate fund with a 1 year maturity would do better. But actually the net maturity of 2 years for the floating rate fund would mean he might outperform the 1 year fixed. So therefore it's very important to not just characterize all floating rate funds as one. I think that's one very important takeaway. Number two, very importantly, to look at the net maturity and therefore then decide whether that fits into the view or the expectation that an investor has. You can't have a situation where a floating rate fund shows a net maturity of say 3 years and an investor coming in expecting protection in a rising interest rate environment. The two just don't, match.
Arvind, also for somebody who's new, could you explain what rising interest rates and falling interest rates mean for debt funds in general?
Sure, sure. So in that sense, if we'll keep aside the floating discussion for this.
Yeah.
When I buy a bond, uh, let's say a 3 year bond at 5%, I am getting fixed 5 rupees every year and I'll get my 100 rupees at the end of 3 years. But I'm committing to my fixed rate of 5% for 3 years. When interest rates go up, and by interest rates we mean say the general risk-free interest rate, you could say maybe the government market or the T-bill market goes up, your discounting rate of 5% increases, which means my opportunity cost of getting only 5 rupees has now gone up. I could have otherwise actually got 5.5 because generally rates have gone up, but I have committed to 5%. Now what will happen is, say interest rates generally in the market go up, I have lost an opportunity to get 5.5% and I'm only getting 5. Therefore that loss of opportunity gets reflected in the bond price, because now I will discount 5 rupees at a much higher rate, and which will impact my price of the bond. And therefore you see uh, for that period of time, maybe a smaller period of time, a negative impact. Of course, over time, since I do accrue 5 rupees still, and that 5 rupees is still to be accrued, it is not necessarily just interest rates going up alone means negative return. It might mean for a small period of time, depending on the bond that you're holding. And then you have your accrual benefit over that period of time. And the reverse happens as well, is when I have committed to and I've locked in 5 rupees and all of a sudden interest rates come down, all of a sudden my bond is that much more valuable because it is getting 5, whereas today that same company might issue at 4%, just theoretically. So my bond is more valuable and the price goes up.
In a previous episode, we had spoken to Suyash from IDFC Mutual Fund about how core and satellite approach to debt investing works. And in that context, where do you think the floating rate fund would fit into the framework, and how should investors invest in this fund?
Sure. That's a very good question, and I didn't touch upon that actually initially, so this gives me a good opportunity. The way we want to construct our floating rate fund is we do want to include an element of uh, slightly lower rated bonds in the portfolio. So what we have mentioned in our PPTs and our marketing documents for the fund is that the fund will have uh, at the least 70% in AAA A1 plus securities. The rest 30 could be of lower than AAA rated papers. Of course, with the other caveat that we will not go below AA minus at the point of investment. So you could potentially therefore look at a diluted credit strategy in this fund versus say a traditional core bucket fund like a low duration or ultra, which buys almost entirely 100% AAA and A1 plus. As a result of a slightly diluted credit strategy, we have bucketed this in the satellite category because it is not just the interest rate risk here that may be lower, so therefore it could form core, but the interest rate, the credit risk element of this means that we are bucketing it in the satellite fund category.
Um, how should investors go about analyzing these funds before they invest? What should be the things they look at before choosing one of the floating rate funds which are available?
Sure. I think like with most funds, one would look at the average maturity of the fund, the net average maturity. And like I said, that is very important to look at in a floating rate fund so that you are aware that it's not purely fully floating and will have a certain mark to market impact on both sides. So the average maturity, the strategy that a floating rate fund of the fund house has communicated, like in our case, we are saying it's a slightly diluted credit strategy, which will have therefore up to 30% of allocation in non-AAA papers. So it'll all depend on various aspects. Also very important for investors to note that as a category, apart from the 65% requirement of floating rate instruments, there are no other defined boundaries for the fund as per SEBI's classification. Therefore, there are no bucketing of maturities like you see in a short-term, medium-term duration. So it could be very varied across fund houses. So it's important to understand what fund houses are looking at in terms of their maturity profile, the amount of credit risk they want to take, the amount of hedging they're doing. So it does require a little more involvement from them in that sense to understand the strategy within the floating rate system that they're employing, because you will see a lot of differentiation between different fund houses on how they construct or how they use this product as a strategy.
Arvind, you mentioned that 30% of the fund might be investment can be in papers which are less than AAA. Now, why would that be? I mean, what is the reason for having the higher credit risk exposure?
Sure, that's a very good question. See, we think from a macroeconomic standpoint, things are definitely improving, which warrants a certain amount of additional risk that we could take without having too much risk on the portfolio. If I were to just summarize some of the macro points which support taking additional credit risk today, one is if you look at just the banking system, the amount of capital that they've raised, the amount of very proactive provisioning that they have done on their loan books, and also in a lot of cases, the actual NPAs or stressed assets that they're reporting are far lower than what people had initially perceived. So the banking system is far cleaner and far more improved today. Manufacturing system, the manufacturing corporates, etc., are starting to do quite well and start rebounding quite well today on the back of various government schemes, as well as their own measures of cost cutting, divesting assets which are non-core to them. Even to some extent, a sector like real estate, which was not doing too well in the past, is starting to see some buoyancy. Add to all of this, macroeconomic policy or the RBI is truly accommodative in the sense of liquidity and from a rates perspective. And even fiscally, you're starting to see some buoyancy in government revenues. All of this makes us guarded, but also slightly more bullish now on the credit part. And therefore, it's not the worst time, or it's maybe a good time to look at some part of your allocation within this fund into credit. But again, keep in mind, it's not an all-encompassing view. In credit, you still have to be very bottoms up as well. just because a broader theme or the macro is doing well doesn't mean all companies are doing well. There are companies which are still struggling, either because the sector is not doing well or the companies themselves within that sector are not doing well. So not here to say that everything is okay on the ground, but things are therefore gradually improving, and hence we are comfortable with a small allocation to credit within this fund, which in turn gives a slightly higher yield therefore.
Arvind, this is probably the most important question that people might expect. Um, how much returns, or let's say, how should investors think of returns in these funds?
Okay, that it's the most important and the most toughest question, and I will have to do my best to duck that question. Uh, and I think we have learned this in the past, right? So we have learned in the past that trying to predict this or trying to use various concepts like YTM minus expense, these concepts don't always work, and therefore trying to predict a certain return profile. Neither is easy, nor I think is it even very useful. I would still therefore then go back to the asset allocation framework. I know it's a boring answer for the question that you have asked, but the asset allocation framework kind of helps address this to an extent. I know there is no answer to this question. So the only way is to address this question, which is if you bucket your investments in a core and satellite strategy, wherein your core gives you that FD type of return, which is more stable, and the satellite bucket allocation tends to give you a slightly higher return potentially, but also with its own amount of volatility. So you have to be able to stomach that, and therefore your expectation should be accordingly aligned. Would at least help you navigate this. Would it still give you an answer? It will not, of course. But yeah, that's the, I think, best way to address this query.
And just a follow-up on that, as a thumb rule, what would you say would be the right amount of allocation in terms of percentage, let's say, of the overall debt portfolio of a person in floating rate funds?
I would say, given it comes under the satellite bucket. In general, and there is no fixed percentage. So this is just a very general range. We believe the majority of your portfolio should be in the core bucket. Now, majority could be 50, it could be 60, it could be 70, it could be 8, depending on the risk profile of a customer. So assuming, say, let's just say 70% is in the core bucket, you have another 30 rupees in the satellite bucket, uh, which could be a mix of duration strategies, credit strategies, and in our case, our floater fund, which we think is satellite. Again, not to say all floater funds are satellite. We are classifying our floater fund as satellite because of our extra element of credit risk in it. Maybe someone doesn't. Maybe someone runs a pure 100% floater fund with a short maturity that could just be in the core bucket. So again, you have to nuance that a little. And therefore, I would say since less than a majority of your allocation should be in the satellite, and this is one of those products, of course, therefore you have to accordingly, I don't have a clear number there to give, but yeah, you get the range of what I was talking about.
Arvind, let's talk a little about you. How do you personally invest? Are there any mistakes that you've made and learned from? Anything that you would want to share with the listeners and viewers today?
Sure. I'm not sure too much of, I mean, I don't know about mistakes, so I don't really analyze that part of it. That's actually a good question. I'm not sure. In terms of investing philosophy, very simple. I mean, almost all of my money is in mutual funds, and it's very simply a mix of debt and equity. Neither have I found any new great avenue, or do I get into too many exotic things. It's quite simple and boring. Of In fact, I do hear somewhere that the 100 minus your age should be equity. I think there was a period of time when I even followed that concept. I don't even know if it's right or no, which is 100 minus your age should be your equity and the rest should be debt. Uh, but yeah, that's how simple I keep my uh, uh, personal investments. Uh, and yeah, that's about it in terms of
Are there
my
any
personal practice.
investors you admire or any books that you might want to recommend to our listeners and viewers?
I'm actually the not the best person to advise, because to be fair and very honest, I don't read too much of these investment books. I know there are a lot of people who really do that, and I do commend them. Uh, I'm someone who's it's a little boring, but I like to read an annual report of a company, or understand what they're saying. I don't actually have not read too many investment books or follow uh, s- uh, every word of what a certain person says, because I think that may not always be too useful as well. It is definitely useful to read as much as possible of various views people give on the market. And it cannot be any one specific person, because not one person is the right all the time. So I think the only advice I would give is maybe read as many views as you can, and also read views which may not be similar to your views. Sometimes it's very comfortable to read a view which aligns with your view. It's good to read the opposite side of the view and understand where it's coming from, and therefore can also test your own hypothesis. But that way, yeah, I keep it simple in terms of reading more company commentary or market commentary of people, not really the age-old sayings that a lot of the investment gurus talk about. I'm not uh, I'm not someone who follows a lot of that very religiously.
And the amount of time somebody spends analyzing what they've done and how their investment strategies have worked might give them much more insight than, let's say, reading a book might. So maybe that's something investors could do in general as
Yeah,
well.
potentially. That's a good point. Yeah.
Thanks, Arvind. Thanks for doing this for us. There were a lot of takeaways from this. I'm sure everybody who's tuned in has also enjoyed and learned a lot from this. Thank you,
Sure.
everyone, for tuning in as well. Uh,
Thanks a lot. Thanks for having me, and hopefully we'll speak again soon.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.